Thanks, Roy. Good morning, everyone. On behalf of Asian Markets, we welcome you all to the 1Q FY19 earnings conference call of Elgi Equipments Limited. We have with us today Mr. Jairam Vadaraj, Managing Director representing the company. I request Mr. Jairam to take us through an overview of the quarterly results, and then we shall begin the Q&A session. Over to you, sir. Thank you.
Thank you, Kamlesh. Good afternoon or good morning, ladies and gentlemen. Thank you for taking the time to be with us for this call. As usual, I will take you through our consolidated results for this quarter in comparison with the same quarter last year, and talk a little bit about the business conditions, and then open it up for questions. At a consolidated level, our sales grew by about 15% over the same quarter last year. Our contribution has been relatively the same. At a contribution level, we probably lost about 0.6, 0.7%, but that's primarily because of a product mix and a little bit of a challenge on our commodity prices during the first quarter. We're taking some action to recover it, and we're confident that the balance of the year we will come back. So with a 15% growth in revenue, assuming the same cost levels as the previous year, our EBITDA should have been 625 million, whereas it has been only 394. There's been a cost impact to the extent of 231, which I will explain to you. Our biggest cost increase during this quarter has been in manpower cost, and that too close to the extent of about 103 million, and close to 65% of that increase has been from India. There is a pressure on people cost, more than from a point of view of attracting talent as well as retaining talent. We expect this pressure to continue for the next few years. We are also working on alternate strategies to mitigate this. On the variable cost, we've lost about 50 million, and this is again due to the mix variation, which is not something that I'm unduly worried about. On fixed cost, other fixed cost, is another 50-odd million, and that's primarily because we changed our accounting policy for R&D material. Earlier, we used to expense off material acquired for R&D purposes at the time of actually issuing completion of the project. But from a prudency point of view, for this year onwards, we decided that we're going to write off everything that we buy for R&D. So that's out of that 50, close to about 20 million is because of that. We also had a CRM implementation this year, which is a one-time expense. I don't see it repeating itself. So overall, I would say it's been a good performance. It could have been a lot better. And even in the top line, we were probably 2 to 3% shorter than what we anticipated to be. But basically, both the top line and bottom line have been reasonably good. In terms of our debt position, right now, it still remains pretty flat at 152 crores, 1,522 million. This quarter, there's been a significant increase in our inventory. We anticipated reduction, which has not happened, and that has really put a pressure on our inability to reduce our debt. We are still hoping that, as promised by March 19, we will significantly reduce our debt. We are hoping that we will become debt-free without the Pulford's acquisition on a business-as-usual mode. We expected that by March 19 we will be debt-free, but I don't think we will be unless we are able to do something extraordinary in our working capital on inventory and receivables. We're working on it. We are hoping that something comes, but I'm not at this point able to commit with conviction that we will extract that much cash from the system. There has been a bit of an anomaly which was there even last year, but it looks a little stark here between the consolidated results and the standalone results. There is a difference. Consolidated result was in terms of profit after exceptional items, it's 292, whereas standalone profit after exceptional items 308. So there is a natural thing is why is the consolidated profit lower than the standalone profit, especially when all the subsidiaries have gone past the earlier period of making losses. And this is a first quarter phenomenon that if you look at last year's consolidated and standalone, you see the same anomaly. And that's because of dividends coming in from our subsidiary ATS during the first quarter. In the consolidated books, it gets netted out, whereas in standalone, it is comes in as a dividend. So other than that, I'm going to rely on your questions to clarify more on our results. In terms of the general business condition, India continues to be rolling along. I wouldn't say there is any significant increase in the intensity. Neither do I see any reduction in it. It is just rolling along. We are riding the wave of that. We've also got some strong processes in place in the market, and we're beginning to see some results from that as well. So India has done well in the first quarter. Both the US and Europe continue to contribute for us. The growth rates have been pretty significant. The Southeast Asian and Australia market compared to last year has done significantly better in this quarter, and that has also contributed. Our challenge has been the Middle East and Brazil. Middle East, as we've had issues with distributors, there are some receivables. We have had to curtail business with these distributors as a means to manage reduce risks on our receivables. We are working on some alternate go-to-market methods to mitigate this. It is probably going to take us another 6 months to put that in place and start seeing some results. In the meantime, we are working with these distributors to see how to overcome this situation. Brazil, the economy continues to be a challenge. In spite of the problems, we have done well in our industrial machines. It's the portable business that has been quite challenging in Brazil. But our aftermarket and our industrial has grown. We are maintaining our position in Brazil. We're trying our level best to ensure that there are no cash losses. We have to stay in that market. It's a significant market. The fundamentals of the economy are very sound. Once the political situation gets resolved, we expect that it will be a good market to be participating in. So no serious damage coming out of Brazil, but we are watching it very carefully. I'll talk a little bit about our acquisition that was announced recently, which is Pulford's in Australia. Pulford's is a pretty significant sized distributor of compressors and a service company in the market. They have been our distributor for a year now, and this has given us a good opportunity for both LG to understand Pulford's and for Pulford employees to come to appreciate the performance and quality of LG products. So this has been a good platform based on which we went to the next step of acquiring the company. They have a very strong presence in the major industrial areas of New South Wales, Victoria and Queensland, and they have reseller network in other areas as well. But with this acquisition, with Pulford being such a strong platform for LG, we can expand pretty significantly into the other areas in Australia. We've got a good leadership team in Pulford that has come on board, and so things look pretty good for our business in Australia. So with this, I will conclude my conversation, and I will rely on your questions to clarify the situation. Thank you.
Sure, thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Anyone who wishes to ask questions may press star and 1 at this time. We have the first question from the line of Aditya Bagul from Axis Capital. Please go ahead.
Thank you. Good morning, gentlemen. Thank you for taking my question. I have two questions, sir. Sir, it's about a year and a half since we've tied up with the BCG on the domestic front. Can you give us some granularity as to what kind of developments have we brought in place? And in your initial comments, you talked about some improvement in processes which has driven domestic growth. So if you can just elaborate a bit on that.
Okay. What's your next question?
So my next question is actually a data point. I just wanted to know why the tax rate was higher in this quarter, and what is our guidance for FY19.
Okay. So Aditya, I don't want to give granular details of what has been the impact of the BCG initiatives into our top line. That would be even as both of us are conversing with each other. The competition is going to get to hear this, so I would like not to feed into that. But what the process has helped us is to start participating in greater opportunities in the market regionally as well as with various customer segments. It has brought a certain robustness in the way we are having conversations with our customers vis-a-vis competition, which again builds a certain credibility and therefore the effectiveness of the sales conversion. So it's been a very comprehensive and involved process, and it's just raised the game for LG in the marketplace, and the results have been positive, but I don't want to talk about specifically what the percentage improvements have been.
Sure, sir. That is quite understandable.
Yeah, and coming to your tax rate, it is really, if you look at the tax-paying entities alone are considered, the effective tax rate in Q1 is pretty much the same as the Q1 of last year, as well as the whole year's tax rate in 17-18.
Okay, sir. That's helpful. Sir, if I may just squeeze in one more question here. If you could give us some understanding on how our new oil-free compressors are, what is the feedback in the first few months of putting the product in the market?
We have, I don't want to say the total number of machines, but a significant number of machines are already running in the market. Zero complaints from customers, and the performance of the machines have been exactly as we expected them to be. So it's a very positive feedback so far. We've got orders from pretty large automotive OEs, which we hope to execute in the next few months. So things are actually looking good and they are on track.
Great, sir. That is encouraging. Sir, and just one last question. In our last quarter, we've talked about our domestic growth of about 13 to 15%. Do you think that with some improvement in the domestic ordering scenario, we would be able to surpass this number, at least domestically this year?
Well, we are targeting, if you look at the first quarter in the domestic market, we've grown about 15%.
17, 18, yeah.
Well, if you look at domestic, because standalone is not exactly domestic,
sure.
Right?
Sure.
So, we don't see any reason why this rate should not get sustained over the next 3 quarters.
Great, sir. That's very useful. Thank you so much and best of luck for the quarters to come.
Thank you.
Thank you. Participants who wish to ask questions may press star and 1 on their touchtone telephone. Anyone who wishes to ask questions may press star and 1. We have the next question from the line of Rohan Pinto from ICICI Direct. Please go ahead.
Hi, sir. Thanks for the opportunity.
No problem, Rohan.
So I just wanted to get some understanding on environmental control system equipments. So basically the ideology is for this controlling SOx emissions in power plants, you require an FGD technology. Now from what I've read, sir, you also employ air compressors there. So just wanted to have your understanding on, is this a market that is addressable to us?
You're talking about flue gas?
Yes, flue gas, FGD, right, that's right, sir.
Yeah, we are not in that, you don't need a compressor for flue gas treatment.
Desulfurization, okay.
No desulfurization, we are not involved in that process at all. In the power plants, primarily a compressor is used at 2 levels. One is at the instrumentation air where you need oil-free, and then low-pressure air for ash handling.
Okay. Okay, thanks, sir. Sir, I had one more question on. I know you've been. This is with regards to aftermarket share of our company. From your previous con calls, I understand that we had around 20 to 25% aftermarket share in domestic, and when it comes to our foreign subsidiaries, it was around 10%. So over the years, I don't want the pointed numbers. I understand you would not be able to give them, but have we improved our aftermarket share?
I think we are in both the domestic and in the international markets. We have improved, right? But we believe the opportunity for that is even higher, and we are working on very specific initiatives to be able to extract that value.
Right. So because the thing is, the more compressors we manage to sell, and that's basically our market. So the more we sell over a longer period of time, the more aftermarket service we can generate, and these revenues are going to be stable. So what are your views, sir, over a decade or over the next 5 years? How do you see this market panning out for LG?
I don't understand the question in terms of
in terms of what I'm trying to understand is, what I'm trying to understand, sir, is, say over the next 5 to 10 years, we have a market share of 20-25% aftermarket share. Where are we? I mean, what are the percentage share that we are looking to achieve? And do we have a number in mind? That's where I'm heading towards.
Yeah, the global benchmark at a average level is around 30 to 33%, right? And that's not an unrealistic percentage to aspire for, right? But there are also companies that have it as high as 50%, right?
That's right.
So it really depends on what value chain that you participate in the aftermarket. If you're only at the parts level, then it's probably between 30 and 33%. But if you start offering even services which currently distributors offer, then your percentage of aftermarket revenue could be higher. But as a principle, LG is more distribution-oriented. We are distribution-friendly. We want to partner with distributors. So for us, the 30 to 33 is a more relevant benchmark.
Sure. Okay. Thanks so much for answering our questions, sir.
Thank you. The next question is from Aksh Vora from Praj Financial. Please go ahead.
So I just wanted to know from which segments have we seen the growth coming in for domestic revenues, particularly which segments or sectors have done well for us?
I wouldn't say there is any one sector that is overwhelmingly stood out. We can say power is one sector that has not contributed significantly, but pretty much all other sectors have. But having said that, if I break it up a little bit more, at an aggregate level, break it up, the large, infrastructure type of businesses like steel and cement and power have not really contributed as much. It's the general small to medium-sized industries that have really contributed. But having said that, we're beginning to see an interest picking up in cement and steel, so it should, in the future, they should start contributing.
So, in past, we've seen good activities in construction, mining, and I think textile, pharma side. So, is that growth continuing?
Yeah, it is.
Okay. If you can just give me growth numbers in segments, if possible.
No, I would prefer not to do that.
All right.
That is comparatively too sensitive. Yeah.
Sure. I understand. And also, recently in competitors' annual reports, I've seen they've saying that they've been losing market share because of pricing pressure. So, just wanted in perspective, how much have we gained market share in recent times from competition because of pricing things?
First of all, we don't lead with pricing. We are not, our entire sales program is not built around low price. So if the competition, I don't know which company's annual report you're referring to, but if they're talking about, so they're talking about losing market due to low price. I don't know who they're losing to, because we certainly are not reducing our price. So I don't know whether the problem is with the price or cost. So I don't know. It's very difficult to talk about increase in percentage of market share. Firstly, because in India there is no common body to whom all the manufacturers report their sales, so that there could be a collective understanding of the market size and market share. So it's very difficult to say. Second is, we have some internal assessment by which we say how much we have gained, and I wouldn't like to share that information here, because that, again, like I said, there are people listening who I wouldn't like them to report a number.
So lastly, what would be the utilization in domestic front, capacity utilization? Again,
our capacity is used across multiple products, and depending upon a given year's product mix, the capacity utilization significantly varies. For instance, if the water well segment is really firing on all cylinders, they need large machines, the capacity utilization will be pretty significant. When they don't fire, like they are not firing right now, the capacity utilization is pretty low. So, it's very difficult to give you a general answer. But Do we need significant capital to continue to serve this market and ride the future? No. Earlier, I've always maintained we need an ongoing investment of around 30 crores on an annual basis towards balancing equipment, quality improvement, R&D. That continues to remain valid. There are specific projects in any given year, like right now, we are setting up a motor manufacturing facility which will absorb a significant capex beyond the 30 crores that we normally do. So there is nothing. If your question was to understand if there are going to be a huge cash out because of capital, no. For normal capex, no.
Okay. And sir, you just mentioned that steel, cement have been little bit improved in the current quarter. Do we see any, just when these sectors are about to revive, you are the guys who would be seeing the growth signs at the initial moment. So do we see significant demand coming over the next couple of years?
Well, to set the facts right, the compressor is the last equipment that is bought. So we are not going to be the first guys to see it. But the fact that there are inquiries that are coming to us, and we are the last guys generally that cement companies or steel company or any company talks to in terms of their overall capex program, I think they must have gone quite further along on actually making decisions on investments.
Okay. All right, sir. That would be all. Thanks a lot.
Thank you. The next question is from Krishna Kumar from Sundaram Mutual Fund. Please go ahead.
Hi. Good afternoon, Dr. Jairam. Sorry for the repetition. I just missed some part of the initial comments. So if you could just give some color in terms of profitability improvement across, is it being led largely by product mix improvements, or is it also to do with cost optimization? If you could give us some color on that, that would be helpful.
The profitability, actually, like I explained to you, at a margin level, we have actually improved. We have actually improved a little bit in terms of percentage at a consolidated. In standalone, we have probably deteriorated a little bit at a margin level. I wouldn't say that there is any deliberate attempt to either realize better prices or any deliberate attempt to significantly reduce any input cost. The normal ongoing price increase initiatives, ongoing cost management initiatives are just the routine stuff, nothing significant.
And going forward, do you see any mix change that will help the company in terms of products, in terms of as you see the customer demand into the next 12 months, is there any shift that you're seeing which can give you better margin profiles from a mix perspective?
No, we don't see anything significant, any significant shift in product mix that is going to happen in the next balance of this year. We don't see it.
And the water well segment particularly, how is there kind of demand in our key markets, sir?
Water well?
Yeah.
Water well is pretty dead. The demand is pretty dead. Yeah. Okay. So it's almost non-existent right now in terms of people buying compressors. Yeah.
Lastly, we as the family as promoters are around 32%, which is, far lower than, probably most managements would like to be. So is there, any thoughts on that you would like to share in terms of taking it to on a higher level?
Every percentage that we have to acquire is going to cost us close to about 50 crores. And if you're able to give me a lot of money without asking me to return it back to you, then I would certainly look at improving my percentage. But as it stands, we don't have a cash flow to look at those kinds of opportunities.
But would we use the kind of buyback route, etc., to try and also distribute cash?
The buyback at the current multiple, you've got to look at how is your cash best used. Is your cash best used in investing into the business and providing better return to your shareholders, or is the cash better used to buy the shares, therefore better return to not only the exiting shareholders but the existing shareholders? But at the current pricing level, it does not make any sense to do any buyback. But having said that, even if there was an opportunity, today our biggest aspiration is to grow this business to a significant level globally, which means there are profitable investment opportunities either in the form of acquisitions or in the form of organic initiatives in different parts of the market. And that's what we will really look at using our cash for.
Thank you, sir. Thank you, and wish you all the best.
Thank you.
Thank you. Next question is from Aditya Bagul from Axis Capital. Please go ahead.
Thank you for the follow-up opportunity, sir. Just on your previous comments, just wanted to ask if you're contemplating any new inorganic opportunities, and what segments or what geographies would you be targeting in this?
Our strategic focus is the North American, European, Indian, Australian, Indonesian, and Thailand market. These are the markets that we have identified as strategic. Any inorganic activity is going to be within these geographical domains. Now, there is nothing that is concretized to the extent that I can make a communication about. There are multiple opportunities in the pipeline that we are exploring and having conversations with.
Sure, sir. Just a small clarification there. Would you be predominantly looking at a distributor / a service agent kind of a model, or would you also want someone who has some manufacturing capabilities?
We've announced this before. We are not really interested in buying any manufacturing company. Our inorganic directions would be access to customer type of acquisition. So which will be primarily distribution service companies.
Perfect, sir. That's quite helpful. Sir, and you've talked about a few geographies. If you can just talk a little on how you see China developing. And secondly, if you could talk about the performance of Rotair.
China, we have hibernated, and we've explained this on multiple occasions in the past. We are just hibernating China. We are still remaining there to support our customers there. Our focus is going to be in these geographies that I mentioned, and therefore China is not a focus for us, even though it's a big market. It needs a different strategy and different set of competitive levers to win there. Right now, we are not interested in building those in the company. Rotair has done well. Its manufacturing program is the portable business, and it has done well in that segment. That is worldwide. It also sells It's our platform in Italy for selling our industrial machines, which have also done exceedingly well. So,
great, sir. Thank you so much.
Thank you. Next question is from Harish Biyani from SBI Mutual Fund. Please go ahead.
Hello.
yeah, Harish.
Yeah, sir. Good afternoon. Sir, this acquisition of Pulford, you shared the turnover number in the press release of Aussie 18 million. Is this company profitable? One, and I'm presuming that at this point in time, the share of LG compressors here would be fairly low. So how does it typically work out, say in 2, 3, 5 years time frame in terms of the increase of our compressors? One, B, in terms of when we get into any distribution, what are we thinking of from a slightly medium-term outlook on how big can we scale up these kind of distributors? Hello?
Participants, please stay connected. We seem to have lost the line for the management. Please stay connected while we reconnect them. Participants, thank you for patiently holding your lines. We have the line for the management reconnected. Over to you, sir.
Sorry, I apologize for that disruption. To answer your question, sorry?
Should I repeat the question, sir?
No, I got your question.
Okay, sure.
Profitability of Pulford is pretty strong. I don't want to give an exact EBITDA number, but I can tell you it is better than LG's EBITDA number, right?
Okay.
So it's a profitable organization. In terms of yes, right now I don't want to give you the breakup of that 18 million in terms of products, aftermarket, in products, what is the various brands. But you're right. Right now, the percentage of LG sales to Pulford sales is low, but that gives us the headroom for increasing LG sales to Pulford while continuing to retain Pulford sales numbers and profitability under the assumption of no growth. That means the entire system is going to earn more profit, even if Pulford doesn't grow. But like I said before, because of our products, our quality and our support on one side, and the platform that Pulford has in Australia, it's easy to double the revenue of Pulford over the next 2 to 3 years' time. So we are going to be riding at multiple levels in terms of profitability.
Wonderful. And so, previous participant had asked this question, but so all these bolt-on acquisition that you will keep doing, hypothetically you get good valuation or it fits with our strategy, long-term strategy. Yeah. Is there a particular number that you have in mind over the next, or are these 5 geographies or 6 geographies that you talked about, you'd ideally want one each over the next couple of years? We would want to acquire distributors in each of these.
One is to put down our desire, the other is, getting actually opportunities to acquire. They don't come in the time frame and our desire. I mean, these things are opportunistic that come up. So it's very difficult to predict it. But we do have an internal kind of a financial projection of what percentage of our growth is going to come from inorganic opportunities and what's the kind of commitment of money that we are going to have to make to acquire them. So, but that's again very confidential internal information. I wouldn't like to share that in this forum.
Sure. So third question on the model distribution that you had set up in Coimbatore and you wanted to share the learnings all across India. Where are we in that particular journey? Are there more model distributors that we would be setting up in India or overseas?
No, we wouldn't like to. What we did in Coimbatore was only a model. We didn't want to replicate it by taking ownership in other distributors in India. Almost all of our major distributors have visited this facility. They have seen how successful it can be, and we are already beginning to see fundamental change in beliefs followed by different kinds of action in these large distributors as a consequence of what they've seen with our distributor in Coimbatore. So it's been positive. Are we going to do something like this in other markets? There's a possibility that we could consider something like this in America, where if we are not able to get distributors organically to support our products, if that is going to be a bottleneck in terms of achieving our sales targets, we will look at this as an option, yes. But it's still early days for something like that.
Sure, sir. Thank you so much. All the very best.
Thank you.
Thank you. The next question is from the line of Manish Goyal from Enam Holdings. Please go ahead.
Yeah, very good afternoon, sir.
Hi, Manish. How are you?
Good, sir. Thank you so much, sir. So just wanted to get a sense on, so you mentioned that domestic sales have grown 15% and the standalone operations have overall seen a 18% growth, which implies that exports have grown much faster, and which probably also is reflected in the international subsidiaries, would get reflected in international subsidiaries. So can we expect that international subsidiaries to grow much faster than the 15%?
Yes, absolutely. Yes.
So because last year the growth rate was upwards of 25%. So can we maintain that similar number?
At specific countries, yes, but when you have a challenge like what we are facing in the Middle East, where there has been a payment issue and we have deliberately curtailed our sales, you can't. If you put that into the mix, there could be a bit of a depression in the percentage. But having said that, the overall, I don't want to take away the overall optimism of higher, very high double digit, in the 20s growth in international markets.
Sure. And what I probably also infer is from the numbers between Concall and standalone is that margins for international have been much better as compared to, because on a Concall we are seeing EBITDA margin improvement and standalone the margins have declined. So just wanted to know that one is that are we kind of getting any benefit of rupee depreciation into that, or you probably have the top line momentum which itself is helping to give you a better margins?
I think bulk of the improvement in EBITDA at the consolidated international level is the leverage, volume leverage. But there is no doubt that we've also gained from exchange rate. The standalone is because, like I explained to you, there have been at the standalone level, there are certain expense items that we have taken on the way we are accounting R&D expenditure, which specifically affects standalone rather than more significantly.
Right. Yeah, so in that context now, going forward, do we expect like one particular R&D material cost what impacted our Q1? Do you expect it to continue in the coming quarters? And the variable cost also wanted to get a sense that there has been a revenue mix change. So how do you see that going forward?
On R&D expense, Manish, it is an accounting policy adoption that we have done. So therefore, it is going to continue into the quarters. But it is only a timing of cash flow.
Sure.
Earlier we used to carry it in the balance sheet and bring it into the P&L when we ship the goods out. Now we are writing it off and we will recognize the income and the goods received. Right?
Okay.
In terms of variable costs, I don't see it affecting it because this is just in this one quarter we have some shifts in mix.
Sure. Okay. So that would probably get taken care of in the coming quarters.
Yeah.
And sir, on the employee cost, the absolute increase what we have seen even on quarter basis. So can we probably look at this quarter absolute number to continue in the remaining quarters, or this absolute number will also increase?
Absolute number will continue. I don't think it will increase.
Sorry.
This absolute. Yeah, the difference you're talking, right?
No. What I'm trying to say is that the absolute employee cost number, what we are seeing on a consolidated basis in the Q1, that absolute number is likely to be same for the remaining quarters, or this absolute number itself can increase?
There could be some marginal increase in the absolute number.
Okay.
Because we are bulking up on our talent in certain key markets, and that will come. But there will be a commensurate growth in revenue as well. So while you will not get the full leverage benefits falling into the bottom line, it is not going to be like it is going to eat it away completely.
Okay. And sir, on the Pulford acquisition, when do we start consolidating? From when, sir?
From 1st of August is when it is going to get consolidated.
Sure. And one housekeeping question, sir. In this quarter, how much dividend we have received from ATS Elgi and our standalone, sir? Last year it was 4.95.
Both Elgi Sour and ATS put together, we've got 70 million.
Okay. Fine, sir. Thank you so much, sir.
Thank you. Next question is from Kashyap Pujara from Axis Capital. Please go ahead.
Hi, just a follow-up question, more at a conceptual level. Given that our product differentiation and value proposition is pretty much established, what is the challenge to scale up organically? I mean, while you do mention your aspirations for inorganic growth across the multiple geographies that you said, but do you think that having a distilled focus on a few geographies and getting them right and saturating them before going to other geographies would be a right strategy? Or do you think that, going across the board would be, a better strategy? And second is that would scale up organically be a challenge because, we are focusing on inorganic growth by taking distributors on board, so, acquiring them. So do you see that even after establishing a product differentiation and value proposition, actually getting inroads into customers is so much of a challenge organically?
I see multiple questions there. We'll try and sift them through and answer. One, do we focus on specific geographies or kind of do carpet bombing across the entire world? The key to a success in any market is your access to a distributor. Now, getting access to a distributor is a big challenge because most distributors are already tied with existing brands of compressors. Now, if you try and go all over the world and try to get distributors to switch, your effectiveness of that effort is going to be very, very low. You need concentrated effort with repetitive conversations and visits and programs with focused, select distributors to be able to get them on board. If you don't do that, you're not going to be able to be successful. So that's to answer the first question. Second, in terms of having established the value proposition and the value to the customer, do we need to acquire distributors? Acquisition of a distributor has two purposes. One, if you take a country like Australia, a distributor itself becomes the platform for the whole country and therefore is a vehicle for us to expand our presence in that market. If you take a country like the United States, where there is no one distributor that you can use as a platform to launch into the entire market, there are large sub-geographies in that country which are pretty significant enough to warrant a presence. Now, warrant our presence there in order to fulfill our growth aspirations. Now, if you don't have a distributor willing to come on board to sell your product in that specific sub-geography, then acquisition becomes the alternative for us to gain access to that sub-geography. So, it is an acquisition is not about it's just because you have the value proposition established, it doesn't mean distributors are going to come in hordes to take on the distribution of your product. You still need to go and engage much more granularly in the market, and at that point, acquisition becomes an alternative when distributors don't come on board.
Okay, sure. Okay, sir. Thank you so much.
Thank you.
Thank you. Before we take the next question, a reminder to our participants that you may press star and 1 to join the question queue. Next question is from Vipul Shah, who's an individual investor. Please go ahead. Mr. Vipul Shah, you may go ahead with your question. There seems to be no response from the line of Mr. Vipul Shah. We'll move to the next question. Next question is from Aruna Bharti from Parry, Washington. Please go ahead.
Good afternoon, Jay.
Good afternoon.
Yeah, I have just a couple of questions. One is on the other expenses. You talked about two elements. One is this R&D expenses, which is basically written off as part of an accounting change. And the next one was you talked about some implementation cost, which is an one-off cost. I just want to get what is this all about. That's one. And the second question is on this Pulford acquisition, actually. I just want to get your qualitative thoughts on in terms of the current leadership team and given the fact that we have bought 100% of Pulford and how are they incentivized to work for LG. So these are my two questions.
Well, the implementation is for our CRM, which we have rolled out in this quarter. It went live on the 1st of August, but the bulk of the expenses in terms of implementation happened in the first quarter. In terms of Pulford's, the management team of Pulford's continues to stay on. That is going to be our talent platform for Australia at least. We are also in the middle of reorganizing our regional level structure for the business, which will bring in additional leadership specifically, deliberately for this region. So there are redundancies that are built in at multiple levels. In terms of their incentives, these are all people who are quite young. They are not the people who started the business. They acquired this business a few years ago, I think 7 or 8 years ago. They come in with different backgrounds, and their goal was to incubate and encash on a business, which they've done very successfully. Now they want looking at a professional challenge to be able to take this business to another level in the Australian market. Now, the incentive for them to stay on is the challenge of the business itself. We are not creating, and we don't want to create, any financial carrots as a means for people to stay on. We haven't found it necessary with them in our conversation, and we are not going to do that. So the downside, you may ask, so what if they leave? There's enough talent in the Australian market to be able to pick up the pieces and run.
Got it. That's very helpful. Thank you.
Thank you very much.
I have a flight to catch, and I would request that if we can hard stop this in the next 5 to 7 minutes, if it's possible.
Sure. Actually, that was the last question in queue. I would now hand the conference over to Mr. Kamlesh Kotak for closing comments.
Thanks, Roy. Thanks, Jairam and team, for providing all the insight. Thanks, everyone, for joining for the call. With that, we conclude the call. Sir, any closing remarks you want to make?
No, thank you so much, as always, for organizing this, Kamlesh. And I don't have anything specific to add. And I appreciate everyone's time for being with us this afternoon. Thank you.